The Indian rupee has touched a historic low. On 2nd of December 2025, the Indian rupee opened at 89.70 and slipped further to an all-time low of 89.85. This marked a depreciation of 32 paise from its previous close. Not only this, the Indian rupee has fallen about 4 to 5% so far against the US dollar in 2025. Importantly, this decline also comes before the RBI Monetary Policy Committee meeting and in spite of a robust GDP growth of 8.2% in the second quarter. The Indian rupee is hitting record low against the US dollar as global and domestic pressures have intensified. Even as India's economy continues to show strength, this sharp depreciation has raised a critical question. Why has the rupee tanked so hard? There are other critical questions as well, like how will this depreciation impact common citizens and the economy? So let's take a look at these key questions in this episode of News Watch. A major reason behind the rupee's slide was a surging demand for the US dollars as India's merchandise import bill, including fuel, commodities, and raw materials, rose sharply. This surge came alongside a widening trade deficit, more dollars going out for imports while fewer dollars coming in from exports. The imbalance pushed demand far ahead of supply, putting pressure on the Indian rupee. Another big driver was foreign investors, especially foreign institutional investors who have been pulling money out of Indian equities and markets. Persistent foreign fund outflows have decreased the inflow of dollar liquidity, weakening the rupee's support. The withdrawal of foreign capital reduced the availability of dollars in India's foreign exchange market, making the Indian rupee more vulnerable. Global factors have also played a big role in this. A strong US dollar worldwide increased the cost of imports for India, especially oil and commodities, increasing demand for dollars just as supply tightened. In that global environment, emerging market currencies, including the rupee, bore the brunt. Unfavorable global risk sentiment, higher oil prices, and international dollar strength combined to deepen the rupee slide. Many importers and corporates accelerated their dollar buying and hedge cover, expecting further depreciation. That front-loading of dollar demand exerted additional pressure. At the same time, foreign investors exiting markets triggered sell-offs and capital flight, further shrinking dollar supply inside India. For Indian citizens, the impact is immediate and direct. Imported goods, from electronics and smartphones to fuel, fertilizers, edible oil, and raw materials, they all become costlier as the rupee weakens. This pushes up production costs for companies and eventually leads to higher retail prices, adding to inflation pressure. Foreign travel, education abroad, medical treatment overseas, and any dollar-based payments now become significantly more expensive in rupee terms. For families planning international expenses, budgets could go completely off track. Businesses that rely heavily on imported inputs such as auto, aviation, electronics, power and chemicals face margin pressure. Many of these companies may be forced to either absorb losses or pass on higher costs to consumers. Now the bigger macroeconomic impact. A sharp rupee fall can widen India's current account deficit because imports become more expensive while export gains take time to reflect. Higher inflation can limit the RBI's ability to cut interest rates, slowing down consumption and investment growth. Foreign investors also track currency stability closely. A falling rupee can reduce the attractiveness of Indian assets, trigger more capital outflows, and increase volatility in the stock market. For the government, a weaker rupee means higher subsidy burden on fuel and fertilizers, higher cost of servicing external debt, and increased stress on fiscal numbers. In short, a falling rupee doesn't just hit wallets, it impacts inflation, growth, investment flows, government finances, and overall economic stability. The rupee's recovery depends on a few key levers: reduction in import-driven dollar demand, either via lower global commodity prices or a better trade balance, return of foreign capital, fresh FPI or FII inflows, or better investor sentiment, stabilization in global dollar strength and commodity or energy prices, improvement in forex liquidity. So until some of these parameters shift, the rupee may remain under pressure. What do you think? Do you think this rupee crash is temporary or a steeper decline is on the cards? What do you think? Share with us in the comment section below.
If you like this video, then like, share and subscribe to ET Now.